Our next guest says that there has been a sentiment shift to the downside in the markets and that she's seeing a rise in a desire for hedging. We want to bring in Amy Wu Silverman, who is the head of derivative strategy at RBC Capital Markets. And Amy, you use kind of the pool analogy. Everybody was jumping in. Well, it's September, it's getting cold out, and now everybody's out of the pool and it's closing.
Yeah, that's exactly right. If you looked a few months ago, I think we were really at peak tech exuberance. Folks were just hungrily buying call options in your Magnificent Seven. We couldn't get enough of it. And I think the one nuance in options, Becky, is that it's not just that it points to whether a sentiment is positive or negative. It also is a little bit of a tail that wags the dog situation, because when those calls are purchased in the market, it actually exacerbates upside, but the same thing happens on the downside. So we've lost the tailwind now from options being bought, and we're seeing more headwinds from put options being bought on those same Magnificent Seven and overall in the market.
Do you have any idea of what changed the sentiment? What made people less enthusiastic about all of this?
I think it's that they jumped in the pool. It's the participation. The FOMO was kind of not there before. We talked about this lack of positioning, because if you think back to year to date, there's just overwhelming bearishness in the market. You saw it in equity strategists, price targets, and the market really surprised everyone. And so there was this catch-up train that happened. I think that happened. And now from a positioning perspective, you went from having nothing to hedge, needing to participate, to having something to hedge. And that's the difference that we're seeing in the market.
Okay, so the drop in all of this activity, what are your observations from that? What happens next? Where are things headed?
So it's interesting because we're not seeing this overall, pickup in volatility hedging levels. Folks aren't saying, I need to get protected on the market. We're seeing a very stratified response. So we're seeing folks say, I'm really nervous about China. You're seeing that in FXI and EEM, the ETFs related to that. You're seeing that in option spot in Apple, for instance, which has far more exposure to China than in Amazon or Meta. So you're seeing these very stratified responses, but they're definitely there in the options market. And I think that's what you get in this kind of muddle through for the next few months.
It's not seasonally unexpected, right? As you get closer to October, you tend to see more volatility like this. You tend to see swings just like this.
Yeah, that's exactly right. If you look to the past 2 decades, there's always this pickup in VIX. If you just want to use a normalized return in October, that happens. And then, we have these slew of catalysts, as Joe was saying earlier. We have the strike, we have, the geopolitics, we have the debt ceiling. The last time there was a debt ceiling debate in 2011, VIX went to 45. So we're under a 20 handle right now. I'm not saying that we could hit that 45, but there is historical precedent for it. And I think, that overall nervousness is something that will keep that headwind going.
China, and it's not just China, it's also Canada. You've seen concerns around Canada with its housing market. What's been popping up?
Yeah, it always feels a little weird working for a Canadian bank talking about downside in Canada, but that is what we're seeing.
Careful.
I know, right? I should be careful. But this is a theme that I would say investors have to try to play out into Canada this whole year. And part of it is this argument that Canada tends to go quicker than the U.S., so it's sort of a leading indicator. And there's been this concern, to be fair, on Canadian housing even since the end of last year, and it hasn't capitulated yet, but we are seeing more pressing of these through ETFs like ZEB or ITB, which are essentially proxies for that Canadian housing market. There's very different durations in the mortgages in Canada versus the U.S., and there's also different variability in how they pay those rates. So folks are worried if that goes first, does that snowball into the U.S. after?
All right, Amy, thank you for coming in. Would you say that overall you're more pessimistic just based on what you're seeing in the markets too? Do you not sleep quite as well at night?
I know I have insomnia anyway, but I think from a positioning perspective, when I was speaking with you guys a few months ago, it was very noticeable that the FOMO train would continue, and that having lapsed in the market, I think, is something that concerns me.
Money's tight, and then when you raise interest rates, everything, the interest, what you've been pointing out, everything costs more, in addition to what you're already paying at the grocery store and at the gas station. And now mortgages, rent, everything
mortgages,
else.
rent, credit card payments, everything that you've got.
Sooner or later, the consumer's not going to be as flush.
I just think that Daniel Tarullo is right that there are more lag effects, and it
Right.
takes a little while for this stuff to catch up. You don't see the instantaneous reaction from higher interest rates. It takes time.
Yeah, and the opportunity cost becomes higher with rates higher.